Hello, everyone, and welcome to our institutional debate panel. To set the stage, and maybe to state the obvious, we are now a $4 trillion asset class. This asset class can't be ignored. Yet, more than 75% of institutions around the world have not yet invested in digital assets. So I think this is a debate that's happening in every single investment committee around the world right now. And what they're asking is not if they should get in, but it's really how they should invest in this asset class. And we have so many options, right? We can go passive, we can go active. We can invest in venture or liquid. We can invest on-chain, and we can invest in traditional ETFs, ETPs. And that's exactly the topic of our debate. So without further ado, I'd love to introduce our panel. Vivek, Ryan, and please introduce yourselves and tell us a little about who you are.
Absolutely. Excited to be here and good to see everyone. I'm Vivek Raman, co-founder and CEO of Etherealize. Etherealize is a bridge between the Ethereum ecosystem and the traditional financial world. Before starting Etherealize, I worked on Wall Street for 11 years, Morgan Stanley, UBS, Deutsche Bank, Nomura. So I know what the old world looks like, the traditional asset manager and sell-side world looks like. I know what the new world looks like with Ethereum technology, and we're working to bring both of these together and really excited to be here today.
Hi, I'm Lewis. I'm a PM at RE7 Capital. We run 1.5 billion across different strategies, including directional liquid alpha, yield, VC, and we also work with foundations, top-tier L1s and L2s for their ecosystem build-out.
And I'm Ryan Rasmussen. I'm the head of research at Bitwise Asset Management. We are a crypto asset manager that has exchange-traded funds, private funds, hedge fund, staking solutions. We work largely with institutional investors, so RIAs, family offices, financial advisors in the States and over here. So excited to be here and have this conversation today.
Yeah. And hello again, everyone. My name is Chris Solarz. I'm the CIO of Amadeus Capital Digital Assets. I run a crypto fund of funds, investing in both liquid strategies and venture strategies, and we are anchored by a family office that's based here in London. I'm based in New York. But I would love to start maybe with you, Ryan, because Bitwise is a huge player in the passive space. And perhaps this is somewhat of an easy on-ramp for institutions coming off zero. They understand ETPs, they understand ETFs, they like not paying a performance fee. It's kind of an easy on-ramp. Can you tell us, your perspective there?
Yes. Well, that's the sale that we make, and we find that resonates with institutional investors. I mean, most investors in most asset classes take the passive route. And so there's a world here where it does make sense, of course, to go out on the risk curve and try to outperform the benchmark and take the active side of the equation. But I think one thing that we know very well, and I know that many of our investors know very well, is that passive tends to outperform active over the long term. There's a stat that we often talk about with our clients around the outperformance that you see passive strategies taking. It's something like 97% of passive strategies outperform active strategies in equity markets over the long term. So really what we have seen in our seat at Bitwise is that institutional investors who are trying to get off zero, they want to just have broad-based exposure or simple exposure to the market, and they'd rather own the market than pick winners and losers. So we're seeing that happen often with the Bitcoin ETPs. We think index ETPs are going to continue to grow as a portion of what investors, especially professional investors, allocate to. And I do think that's because you want to just own the market, especially when it's just a small part of your portfolio, which for many financial advisors and RIAs and institutional investors, it is a small part of their portfolio. It's a small part of what they think about every day.
And Ryan, can you elaborate, what is the market? Are people going into Bitcoin? Are they going into the Bitwise 10 and kind of getting the top 10? What are they going into when they go into passive? What styles and what are the biggest buckets?
Yeah, it's a good question. So what we've seen historically is that most investors start with Bitcoin. They're getting off zero. They're making a small allocation of Bitcoin. And a few years ago, that allocation was up to 1%, and that was it. More than 1% scared investors. Today, what we're seeing is that 3% or 5% is typically the starting point. Most of them start with Bitcoin, but some are starting with Ethereum because now you have Bitcoin and Ethereum ETPs. And I think there are those that start with alternatives, like crypto equities is really popular in the US for institutional investors because that's a format and a vehicle they're used to. They want to buy a diversified index fund of publicly traded companies. They do that in every other asset class. Why not do that in crypto? So we run index funds on publicly traded crypto companies that we see a lot of people start with if they're not comfortable starting with individual crypto assets. And I think crypto index funds of crypto assets are next once the SEC approves those to launch.
Thank you. Well, I'm partial to this side. Like passive makes a lot of sense, but Lewis, let's get the debate heated here because you are an active manager. You are trying to outperform a benchmark and add alpha, right? Can you give us the other side of the passive active debate?
Yeah, there's definitely a role for both, and I definitely acknowledge that. I remember when I started investing, it was just really about how do I get to sort of broad exposure, so it does resonate. I think the way that I've always thought about crypto, especially over the last 8 years, is it's really just an emerging market, and with that comes opportunity. So I remember one of my old bosses that were living in Russia in the late 90s, and they were having a great time trying to make heads or tails of that market and did phenomenally well, but very much in an active way. So the way that I view this is almost like a period of time that could run for years, decades, who knows, where we have the ability to connect with LPs where they want managers to outperform that benchmark. And it's just really a subset of different investors in terms of what they're looking for. But it really depends on your risk tolerance and appetite as well. So we've spoken to a lot of family offices that actually they're ready or not ready to go into delta neutral strategies, especially the active ones. But that conversation has really changed over the last, I would say, 2 years because of that regulatory development.
And what do you see as the opportunity set on the token picking side? What does it look like today? Why is there such a big opportunity there?
Because there's so much, the market structure, as you are aware of in the last few days, it's challenging, but also brings so much opportunity. So for us, we really look outside of, BTC, ETH. A lot of the investors that come to us, they say, look, we actually either define our balance sheet in SOL terms, we need to outperform SOL, so what can you do to generate those returns? So we really look down the risk continuum, but really in a thematic way, to try and find those winners where we find there's structural reasons to invest in those tokens.
And can you talk a little about your investment thesis? Like, I've noticed we all, as TradFi investors, we want to find value. We want to find like a DCF and cash flows and revenue. And even though those tokens are much more valuable today, crypto has always been so narrative driven, right? So it's the balance between value and growth. It's always the conundrum of an active manager like you. So how do you think about that? Like, how do you pick your portfolio of tokens?
It's fair to say a few years ago, we really were predominantly top down, where we said, look, we've got a worldview on perpetuals, very salient topic now. But we wanted to find the best project in that sector. It's fair to say since then, what we're wanting to do is more bottom up. So say, actually, from a project to project basis, who's generating revenue? Is there any buybacks? And I'm not the only fund in saying that we're all looking for the ones where there's structural reasons to actually have the token. So we sort of avoid the mimetic side of things for the most part. And so we're looking cross-sector, but really in a bottom-up way on a name-by-name basis. And so where you have fundamental traction, does that translate into a reason why the performance of the token could do well based on different scenario analysis?
So you're starting with kind of a thematic view, and then you pick the expression of those tokens from the bottoms up.
That's correct.
Can you just give us a little glimpse of what is exciting to you thematically for the next 3, 6, 12 months from the top down?
Yeah, I'll give maybe a more obvious one and less obvious one. So more obvious one, again, could be the different types of lending protocols. So we're very well connected with, the Aave and the Euler teams. They've seen phenomenal growth. They're really, at the end of the day, could also be a proxy stablecoin play. So out of all of the matters that we've seen over the last couple of days, the one thing that's broken new records from a KPI standpoint is stablecoin supplies. We just breached 300 billion, almost like it didn't even register on the chart. The less obvious one is really bringing IP value on chain. So we're very close to, let's say, the Pudgy ecosystem, where there's a lot of movement and developments to try and get that value to, again, certain stakeholders to try and maximize that impact. But really, it's not just Web3, it's how do we bridge Web 2 to Web 3. And I think that IP value and unlocking that we haven't really seen before.
And Vivek, where do you stand on this, on the spectrum, passive versus active?
I think crypto infrastructure has given us this beautiful opportunity to have every participant choose. And so it really will be a mixed bag. But how we've seen, especially over the last few days of market turmoil, is there is risk to active management, and there's things that crypto infrastructure is still pretty new and pretty, it's still developing risk frameworks, still developing more user-friendly interfaces. So with that, my view has always been, I grew up on sell-side desks on Wall Street, so they're active investors. They pick bond by bond or asset by asset and construct portfolios. I think that institutions will actually be a lot more active in their allocations across the crypto space. I think that retail probably should start passive, because passive for them, someone else can do the management, someone else can do navigate the different intricacies of DeFi, the different protocols, and that's where there's a whole spectrum of possibility. Ethereum's interesting because Ethereum has a whole DeFi ecosystem. So the passive way to invest in Ethereum is to buy ETH and stake ETH, but the active way is to either put your ETH to work in protocols yourself, or to use things like digital asset treasuries, which I know we'll talk about, which will invest on your behalf. But basically, the entire spectrum of possibilities is doable. So again, I think crypto is a unique thing where you can actually do active and passive seamlessly.
Yeah. And, what I think is so interesting about where we are today in the cycle is that if you take all of the venture funds, all of the liquid market neutral, all of the liquid directional token funds, and add up all the inflows, you get somewhere around $100 billion, which as of last week is how much IBIT, the ETF, had in inflows. So you think about like this little drop in the bucket of active management compared to the $4 trillion asset class. Because remember, hedge funds are a $5 trillion asset class in aggregate. But relatively, digital asset strategies, active strategies are so much smaller, which means there's more alpha as well, which is exciting and kind of brings me to my favorite point, is like we have this meeting of, it's like the Venn diagram of opportunity for this secular story of crypto growing, right? All the use cases and the product market fit for Bitcoin and stable coins and everything else, in addition to the active management that's very juicy right now. So like, I kind of love where we are in this almost golden age of Bitcoin, of beta plus alpha, because you kind of get the best of both worlds there. And by the way, I think the Bitcoin beta, which almost to me represents the entire ecosystem, is like such a powerful train that I think it makes sense to start with a Bitcoin allocation and then layer on, active management as it feels appropriate. Because we see in the traditional side, most money managers have their long-only exposure and they have hedge funds and they're different buckets and they're complementary. So maybe we can move on to, I think what's interesting now about this state and time is that year to date, the big flows have come from the traditional side into digital asset treasuries, in through ETFs. Rather than money coming on-chain, it's come indirectly into crypto via traditional equity and fixed income routes. And that's quite unique. I would have expected it would be the other way, in fact, that what we're building towards is an on-chain economy. But maybe we have to take one step backward to go one step forward here. But Vivek, what do you think? I know that you've talked a lot about digital asset treasuries and have looked into that. Like, where do you see this going?
I think part of it has been a lack of regulatory clarity and infrastructure readiness, both of which are being very, very quickly addressed. I mean, we're speedrunning the adoption curve very, very quickly, and it's really inspiring. But it is a little ironic for people to understand the power of DeFi. The best way to do that is to look at how a digital asset treasury can deploy assets across DeFi. Or to learn about staking, you actually deploy it through a passive ETF that's going to, the ETH ETFs will get staking very, very soon, if not already. So that's how everyone can learn about what the possibilities are. And once we start seeing earnings reports from these treasury companies saying, here's how we generate a yield, and then they'll highlight things like Aave, they'll highlight things like Uniswap, they'll highlight things like LPing, that's what'll spark the curiosity, and then people will go to the do-it-yourself thing. I think there's been such an education gap that most people don't know what Uniswap or Aave is. They don't know how to use DeFi. So these bellwethers like the treasury companies and the staked ETH ETFs, they'll show the world what's possible. And then people will start to trickle their own capital and say, why don't we try and do this ourselves? Why don't we try and generate our own alpha? But yeah, it's ironic that it had to start with public companies showing what's possible on chain rather than capital going natively on chain. But it's all going to converge to the same thing, and I'm just excited that now all of it's allowed, all of it's possible, and the institutions are actually doing it.
And in general, Vivek, what is your view on digital asset treasuries? Like, so much speculation has gone in. Like, are these things of financial engineering? Do they have real staying value? Do we need 200 Bitcoin DATs around the world?
So it's a good question. I mean, it's very easy for people to say that there's a bubble and there's too many of these, but if you look, there's thousands of asset managers across asset classes across the U.S. Those can range from hedge funds to BDCs to private companies to regulated asset managers to ETFs. I mean, that's proliferated across the traditional financial sector. There is no reason why we shouldn't have a plethora of different kinds of investment vehicles across the digital asset sector. The ETFs are the most obvious and probably going to be the biggest ones, but there are going to be a slice of capital that can do not riskier, but more interesting things and actually utilize parts of the DeFi economy that traditional ETFs can't do. And so each treasury company can have its own identity, especially when you're in a world like Ethereum where there's a lot you could do with the asset and the ecosystem. So some treasury companies can work with layer 2s, some can focus on restaking, some can focus on DeFi integrations like Aave, some can do all of them. So I actually think there's a lot of different room. There's obviously a power law. The biggest ones will continue to get bigger, but the cool part is you don't need to be big to generate yield in different sources, and so I see a very, very robust ecosystem of treasury companies, and I think they're here to stay.
How do you think the ETH treasury DATs do after we get full regulatory clarity from the SEC to allow proof of staking for Ethereum? I think that's one of the big benefits of ETH right now, ETH DATs, is that they get the internal staking yield and kind of the external yield as well. But now that ETFs will soon be able to do that as well, does that change the calculus?
No, I think it's such a positive. There's so much capital that has to come into the space that both can win. I don't think it's one or the other. I do think that the ETH ETFs won't be able to stake 100% of their balance. And there's going to have to be some sort of buffer there, which is completely fine, and that's how it should be for a passive strategy. I think the treasury companies will be able to not only stake 100%, but they'll also be able to restake and then take that restaked ETH and then lend and borrow against it and use it in DeFi. So you'll be able to do different things that come with higher risk, but also come with potential higher upside as well.
Ryan?
Yeah, I think that's right. If you think about ETH as the benchmark in this scenario, then there is an argument to be said that there will be funds or digital asset treasury companies that try to outperform the benchmark. Just like in traditional equities, you have a colleague actually was saying this to me recently, but you have the S&P 500, and then you have variants of it that make slight changes that try to outperform the S&P 500. And capital flows to both of those things. And I think capital will flow to DATs. I think capital will flow to Ethereum ETPs. I think it'll flow on chain and people will stake themselves. And it really depends on, if you believe the manager is going to outperform the benchmark, then you'll allocate to them. And I do think that there's interesting things that can be done with DATs that you just simply can't do with ETPs. So when it comes to staking, for instance, you can't yet stake Ethereum on ETPs in the US. You can here in Europe, which is wonderful. And once you can stake, then sure, we'll stake the assets, but you can't do liquid restaking. You can't do a number of other activities in DeFi with ETFs like you can with digital asset treasury companies. So I think it just comes down to a little bit of, choose whichever vehicle that you want to allocate to. If you're happy with just the benchmark with a little bit of staking yield, then I think you'll buy an ETH ETP, and there's a small fee associated with that, but you know exactly what you're getting. If you want to try to outperform the benchmark, perhaps you go with a digital asset treasury company, or you'll go with an active fund that is participating on chain more directly. And some of it comes down to access for what it's worth. Some of it's just the reason why we've seen capital flow through ETPs and through DATs instead of directly on chain, as you mentioned, is an access question. And most of the financial advisors that we speak to and the RAs that we speak to in the major wirehouses still can't fully access Bitcoin or Ethereum ETFs, which surprises a lot of people because the Bitcoin ETFs launched in January of last year. But only one of the four major wirehouses in the US have approved access to Bitcoin ETFs for their wealth managers, which means 75% of those big four can't actually buy the ETFs. So they then can buy DATs. They can buy Bitcoin DATs, Ethereum DATs, other DATs, because those just look like other equities to them. So I think it's an access thing, and I think it's a just, do you want to underwrite individual companies to outperform the benchmark, or do you want to just own the benchmark in a cheap, easy to access vehicle that you're familiar with?
Lewis?
Just really quickly, going back to the first bit of the panel, I actually think DATs in a way are kind of blurring the lines between passive and active, because obviously there's an asset management piece to it as well. So ironically, I kind of want to see more DATs because they're going to be using the underlying DeFi protocols. That's great because hopefully I've got exposure to them. But then also they may need asset managers. And look, we've been doing it for nearly 5 years on chain. And so it's really across Ethereum. We're now hearing it on the Solana side as well, where it really needs a bit of a DeFi boost. So really, in a way, like what's good for DATs, I kind of would argue it's kind of good for me on the active side because they're almost crossing that bridge from passive to active.
Can we talk a little about, I guess, Vivek, your future envisions institutions going on chain directly. Can we talk about the evolution there? Like, what do you think is the playbook for that eventually happening? Because right now we're going the opposite way. Right, we're going through these old inefficient systems, and I just think rather than putting Bitcoin into a DAT, we need to tokenize NVIDIA and start truly trading equities, right? But we're going the opposite way. But to get there, how do you see, like, what do you see the roadmap over the next 5-10 years looks like?
I think it's interesting because we're actually going both ways at the same time, which is, again, it's inspiring to see how much innovation is happening. All we needed was a regulatory regime change, and then the willingness of every institution to actually figure out how to come up with a crypto strategy just exploded. So it's been incredible to see. I think that what we've seen is crypto native strategies and assets like staking, like using ETH, getting exposure to Bitcoin, for example, that has gone through public markets wrappers. So that's what goes into DATs, and that's what gives retail and others exposure to DATs. But the opposite's also happening too. People are also in parallel saying, let's bring the real world onto public smart contracts blockchains like Ethereum. So they are tokenizing equities. They are tokenizing fixed income instruments and real estate assets, and I mean, as much of the world as possible. And that actually requires people to be more crypto native, because you can't take a real world asset, tokenize it, and then wrap it back into public equity. Then you're going right where you started. So for people to use real world assets on chain, they actually have to interact with the actual blockchain infrastructure, and that's what we're focused on, because that's where the real unlock comes in. Tokenizing NVIDIA gives access globally to one of the most important stocks in the entire world. It also allows it to trade 24/7. Also allows it to plug into all these different DeFi applications. That's functionality that the traditional finance system does today anyway. You can still borrow against stock, but you have to go through 17 intermediaries, and it's hard and it's inefficient. If you can plug into Aave, for example, that's going to unlock a lot more. So I think it's going both ways, but the institutions are going to figure out that they can actually cut a lot of their costs and unlock a lot more efficiencies if they use on-chain protocols for real world assets. At the same time, to spread the universality and the upside from Bitcoin and ETH and others, putting those into public markets, vehicles, ETFs, and treasuries, we're going that way too.
I love your point about kind of winning on both sides. One of the biggest developments I see in the on-chain side of asset management is the rise of vaults this year, right? We see billions and billions going in. I don't see billions of dollars going into like classic Cayman structure GP/LP funds just yet. I think that's coming. But we do see the ease of on-chain money flowing into vaults. And, I think of them almost as an, the on-chain hedge fund. You get full transparency. You have daily liquidity. You can see the history, how they've made money. You can see in real time what the yield is. This is transparency that I don't get as an investor into most hedge funds all the time. So I love this development, and I think it is the future. And I know, Lewis, for example, at RE7, you guys have done quite a bit in this already. Like, that's the other side of your business. But can you comment a little bit on that?
Yeah, so it's a part of the firm that's grown to basically a yard now. One of the reasons why it's grown so much was, well, one of the opportunity, but really it allowed us to tap into capital in a much easier way, where you don't have to find, type of investors that are able to pull in, a fund structure or a master fund. So when we looked at, this brainstorming idea around vaults, we kind of thought of it as like this new frontier of DeFi, that customizability, that flexibility, but also that transparency. And what's amazing, and it's definitely a learning for me over the years, is with vaults, you really have to, it's all a relationship game at the end of the day, and how many stakeholders that you have to bring together. Being one of the earlier players to do it has really helped, because you have the relationships with the Oracle providers, you've got the relationships with the lending protocols, ... So what a great example that we had earlier this year, really fortunate to work with the World Liberty guys to help distribute USD1. And so the stakeholder setup there was you had the Binance Smart Chain, and they had the incentive to grow their ecosystem in TVL. You had World Liberty that had, I think, 90% of their supply in maybe the top 10 wallets. So they had a distribution problem. But when it comes to incentives, we're realizing quickly that everybody wants to be part of that vault infrastructure. So with the Oracle providers, it's really about how do we better our infrastructure? How do we supplement the incentives even higher, where we're not taking any incremental risk, but actually they're just offering more of their native tokens. So we do that calculus, but it's very much, you know, when I was in Singapore, I was thinking I was going in for many conversations around liquid alpha, but actually I would say 50% turned into, oh, we're actually launching vaults. This is something that you can do there. It was eye-opening. People that, again, Standard Chartered and all these guys that you wouldn't think would even think about doing it. But that's amazing, because it started at the genesis of a brainstorming idea about a year and a half ago. But now it's grown to one of the biggest parts of the business.
By the way, Lewis, I love how casually you dropped $1 billion as a yard. I think when I grow up, I want to be that cool and nonchalant. Very cool. Ryan, can we talk, please, about where we are in the SEC regulatory adoption cycle? We've talked a little about the upcoming. We had the Clarity Act, first of all, in July, and now we have the next broader act coming up to regulate the rest of everything in digital assets. I think this will really bring in the next wave of money, and we already see over 100 ETFs lined up, right? Do you have any insight to share there about what to expect, where we see the flows, et cetera?
Yeah, so the past 12 months, really, in the regulatory and legislative space in the U.S. has been phenomenal. It's been just the most incredible amount of traction and activity in a long-term tailwind as one could possibly imagine. And we've been, at Bitwise, just working day and night to file for as many ETPs as we can, to bring these products to market, to think about how are investors going to want to gain exposure to stablecoins as they grow from 300 billion to 3 trillion, and they want to express their interest in that allocation. Does a publicly traded equities ETP that has companies like Circle or Coinbase make sense? Or do you want to provide some kind of thematic stablecoin crypto asset ETP, something like that? All of those things have been happening, and then it went on pause when the government shut down. So we've had a bit of this kind of sprinting and then stopping. But what we believe is going to happen is once the government opens back up, there's just going to be an onslaught of ETPs launched, and there's going to be something like 25 of the largest crypto assets will meet the generic listing standards that the SEC rolled out, which means that it's a much easier path to listing as an ETP in the US than historically it's been. You won't have this 240-day waiting period that you've had for the Bitcoin ETPs and for the Ethereum ETPs. So we're really excited about that. I think investors will all of a sudden have this big menu that they can choose from. Now, most of the investors that we speak to, these financial advisors and RAs, don't know that much about crypto, or they're early on in their journey. And so they're excited about Bitcoin. They've maybe heard about Ethereum because they hear about stablecoins and tokenization. Maybe they've heard about Solana. But once you get past those assets, we really don't get a lot of questions. Maybe XRP, maybe the Cardano question every once in a while. So I think it's going to take time before flows go into those assets, certainly. I do think there will be more crypto enthusiast investors who do want to go out down the risk curve and they want to choose the lower cap assets. But I also think what's going to happen is you're going to see more thematic and more index funds come to market, which is another element of these generic listing standards that's going to be a huge unlock for asset managers like us at Bitwise, is we can now offer more interesting and compelling and kind of own the market with a basket of assets rather than having to bolt on your own kind of portfolio. So I think that will be where a lot of capital flows, certainly. If you think about the ETP market today, it's like a $20 trillion market. It's a huge market. And right now, Bitcoin ETFs and Ethereum ETFs are like 1% of that market. And I think that will grow to 10% or more of the ETP market once we have more ETPs, once we have index ETPs, and once we have much more options for investors. And now that we have that regulatory clarity and we have the lack of an attack on the industry from regulators and from the administration, investors are sighing a bit of relief. They feel like they can start allocating. They feel like they can go tell their clients they own crypto. And I think that's also a huge unlock. And I think a lot of people are actually missing how big of a catalyst that is and how many years that's going to continue pushing the industry forward.
Just really quickly, it's interesting thinking about the reverse of that. So I just had a notification saying, the S&P putting sort of stablecoin data or risk ratings on chain through Chainlink. Point being is that obviously there's a lot of sort of real-world data that could be plugged into Web3. So one of the things from a vault infrastructure standpoint that we're exploring is indices, on-chain indices, and kind of reviving that old chestnut that we saw a couple of years ago. But you could conceivably do it over anything. So we've been experimenting back in the day with AI agents. Was there any appetite there? But there's a huge design space. And if we're able to do it in an efficient way and collapse the cost of managing it in a vault setup, then that's pretty intriguing. So it's almost like the reverse of what you guys are doing and seeing what the opportunities would be from that.
Yeah. Ryan, you mentioned a few times like the benchmark. And I think what's underlying all of this is that right now we're a lot of the service providers and index providers are almost in a war to figure out who is going to be the S&P 500 of crypto. Because once you identify what it is, whether it's an equal-weighted top 10, equal-weighted 100, asset-weighted, whenever we find this out and people really start to benchmark that, we get the passive flows and we get everything that's kind of indexed to that. And, and look no further. Remember, Coinbase was introduced into the S&P 500 in May. And then by June, all the catch-up that had to happen, it was the best performing single stock out of 500. It was up like 40 or 50%, and that's exactly what we will see. But right now I see, so my role day to day is to cover crypto managers, and I see almost every other manager has a different benchmark. And of course, the game is for them to produce a benchmark that they look better against, that they're producing higher returns, higher alpha against. But it'll be interesting to see how this shakes out, because eventually we will come to some consensus that this is the S&P 500 of crypto. Maybe it will simply be Bitcoin itself, or maybe it will be some kind of index of all of it. But really, it's all over the place, and that's why there's so many opportunities. There's no standardization yet.
Yeah, I think we're very early on in the journey, to be completely honest. I think Bitcoin is broadly looked at by the investors that we speak to as the market or as the benchmark. Of course, at Bitwise, we're biased that we believe the Bitwise 10 large cap crypto index will be the S&P 500 of crypto. So, of course, I'm a little biased to that. But what we've found is that investors like the idea of, hey, I can just buy this one fund. I can own 80% of the market, and I know that it's managed by people that spend 100% of their time thinking about the crypto market, right? Because most of the institutional investors who are allocating to crypto 1 to 3 to 5% are spending even less of their time than that on the crypto market. They're thinking about bonds and equities and tariffs and trade wars and fiat debate, like all of these different things. And so what they want is just one-stop shop. And that could come through things like DATs or like, for instance, we have an index of DATs. So if they want exposure to that theme or they want exposure to a bunch of companies that are trying to outperform the index, then they can get that exposure through an index fund. Or they can go through a vault, for instance, and kind of try to outperform the benchmark. But I think the benchmark is Bitcoin. I think, like I said before, indexing is going to be a huge part of that, and ultimately the benchmark will transition to something like the Bitwise 10 large cap crypto index.
Yeah, I hope so, for your sake. One cute analogy I've heard, which I'm quite partial to, is that Bitcoin is the benchmark for almost the equity-like benchmark, and the ETH staking yield is like the risk-free rate. Like if you can't beat 3%, because remember, like if you invest in the risk-free rate, you don't get appreciation. But with investing in Ethereum, you get the hopefully price appreciation and your risk-free rate. You kind of win in two ways. So like that's exactly what you want to own, is the risk-free rate with asymmetric upside. But I kind of like that. That's kind of like the cost of capital, is you should at least be getting that kind of risk-free rate of return. We have a few minutes left. I think this weekend was such a shock for the whole. In fact, it was a shock in one sense, but it wasn't. We knew that we would have a big liquidity crisis coming someday. We didn't know it was going to be this weekend per se. But I think we were all kind of expecting that eventually this is what crypto does. It has crises, it recovers, it grows stronger, and it gets better. But maybe any takeaways from any of you guys about how we performed, how the industry performed, where we go from here?
I'll go first. I mean, I was fortunate to look at the whole developments with a pretty level head because we don't take leverage in the fund, thank God. Takeaways, and we're talking about it backstage actually very briefly. For me, it's really understanding how things work, especially on the perp side, and hearing of large entities that have positions on, let's say, hyperliquid and not realizing that they could be liquidated even if they're on the right side of the market, sometimes on the bets. I think it's just a bit of a wake-up call to really understand that there's no system that is perfect. Educate yourself in how it works. That's definitely the highest level takeaway. And I think from a market structure standpoint, we're still pretty constructive overall. I think market right now in the short term is trying to find its footing. So there's a bit of a recalibration period, I would say, right now. But from a macro standpoint, nothing's changed despite the sort of liquidation event that we did see. So I think for us, zoomed out, we still think a lot of these kind of fractals have been respected so far. But we're really going to be taking it week by week, day by day.
Do we think this was a flash crash or the beginning of something more long-term?
I'll jump in. I think that this past weekend, it's fortuitous timing for this panel because it actually captures everything we were talking about. So first, active versus passive. The people that were passively just holding spot, especially the index type crypto assets, Bitcoin and ETH, they didn't really sell off that much. I mean, it really honestly wasn't that noticeable if you're just passively holding spot. So it shows that people that start to mess around in more active strategies with 100x leverage in tokens that don't really have that much liquidity or honestly have an inflated market cap, those are the ones that got absolutely destroyed. And that's where do-it-yourself active may be a little bit tougher. And maybe the call to action is let's concentrate on a few blue chips and like Bitcoin and ETH, and then use a much smaller portfolio size for alts. So that was one takeaway. Does it happen again? We flushed out a lot of leverage. So I mean, it was almost, this felt more like a flash crash that we bounced back from than a structural issue. And the structural issues exchanges were very quickly identified, and then we'll get past them. But I think we're gonna resume our uptrend very shortly.
Yeah. To be honest, for me, the reminder was the power and importance of diversification in your portfolio. Like, not just from strategy, but also counterparty, right? Like, which exchange are you on? Which instruments are you trading? There was so much going on. And, over these last few years, I've been pitched by so many of these different funds and different different SMA strategies. And to see 1.6 million accounts be delivered automatically was such a shock. Like, some of these had pitched me how great their risk management were, and I'm finding out where all the bodies are buried, how many of them are worth zero, like gone from 100 cents on the dollar all the way to zero, and you can't recover from zero. So for me, having this like diversified approach really was just reinforced by this crisis we had this weekend. And I think we are basically out of time. I want to thank my panelists and thank you all.